soon as that chimes, we're done. You took your seats, and so we can get started. So I appreciate that. For those of you that I haven't had the honor of meeting yet, I'm Dory McWhorter. I'm the president and CEO of the Executives Club of Chicago. And I am so excited because we have a powerhouse panel for today's discussion, and I am so here for this. I was looking, this group actually comprises some of my favorite people as well as those who currently or formerly represent some of my favorite brands like Pillsbury, Chef Boyardee, and Pampered Chef. It's a great reminder that Chicago is more than a city where deals happen, it's where institutions are built. But before we get started, I want to thank our sponsors. So thank you to our presenting sponsors, CTS Impact and Julie Scott, who serves on our board of advisors. In just a minute, Julie will provide some opening remarks and set the context for today's discussion. Houlihan Capital and Roger Howell, who's on our board of directors, and is serving as our illustrious moderator, and my favorite word, our interlocutor today. And our Nexus sponsor, Riveron, and Michelle Kerr, who's also on our board of advisors, she'll wrap us up with the program this evening. And our featured sponsor, Huntington, and Steve Whitehill, who recently joined our board of advisors, is representing today on behalf of Huntington. I also want to thank the team at the Union League Club for their hospitality and all the great service this afternoon. If you're able, please stay after the program for the networking reception, where we'll be definitely continuing this conversation. And finally, we want your feedback and ideas. So please, excuse me, my mic is like, it got adjusted. So please send us your thoughts at ideas@executivesclub.org. Also, please check your printed materials and our website, executivesclub.org, for upcoming programs and additional opportunities. Now, it's my pleasure to turn the program over to Executives Club Board of Advisors member, President, CEO, and founder of CTS Impact, and my friend, Julie Scott. Julie?
Thanks so much, Dory, and good afternoon, everyone. Welcome. Thanks for coming out amidst the drizzling this afternoon. As Dory mentioned, I'm President and CEO and founder, over 24 years ago, founder of CTS Impact. We're a hands-on business integration consulting firm that provides real-world experience across all aspects of the back office, finance, HR, and IT. So our goal is to provide a practical perspective to organizations going through major change, transformation, ultimately to achieve operational excellence. And we're going to be hearing a lot about that today. I'm also very fortunate to be part of this organization as a member of the Board of Advisors. You may not know a lot about us, but we support Dory and her amazing team in helping to design programming like this. It was actually just about a year ago that we hosted our first private equity panel. Roger and I partnered on that and really tapped into a new area of interest and content that our members were seeking. So we're really excited to have a follow-up on that today. So I also wanted to offer a big shout out to the Executives Club team, Rudy, Dory, everyone, make every detail being looked after. Just so grateful for making it such a welcoming environment. But today we're really here to talk about transformation and how the private equity landscape continues to evolve. So it is now far more than capital. It's a question of what is getting built, who's building it, and what's really going to last. So our theme today is money in motion. We're convening investors, operators, decision makers who are shaping the way that companies are growing in the current environment. So in other words, what's their journey? We want to hear about their stories from first concept to how they built out their models to be sustainable and scalable platforms. So for today's conversation, to share their journeys, we are very fortunate to have several industry leaders and experts to offer their perspective. First and foremost, Alex Abel, partner and head of RCP Advisors. Tracy Britt Kuhl, co-founder of Canbrick. Hank Hertong, chairman and CEO of Brynwood Partners. Shundron Thomas, founder and managing partner of the Copia Group. And finally, to moderate our discussion, we have Roger Howell, CEO of Houlihan. So please join me in welcoming our panel and enjoy the presentation.
Thank you, Julie. Appreciate that. Good afternoon, everybody. Welcome to Money in Motion. As Julie said, I'm CEO of Houlihan Capital. We're an investment bank here in Chicago, headquartered here. We also have a valuation firm where we work with a lot of VC, private equity, hedge funds, SPACs, doing portfolio company valuations. And we do some crypto and blockchain, so interesting and fun stuff. Today we're going to talk really about the journey across the capital spectrum, in the life of a company. And what a great city we're in. It's a great place to start, to grow, to endure, and you can do that all without leaving the ecosystem here in Chicago. So we have some strategic infrastructure. It's not just, pride in the city. We're going to focus on a lot of the chapters of that journey today as companies go from founding to, growth. And it's really about private markets, the majority of this discussion. They're not, disappearing, they're evolving and they're changing. Holding periods are longer, LP interest and expectations are different, and they've been evolving for years. We're going to hear from some of the folks who've gone through that. And it's about building something that lasts. So we're gonna get into that. Before we do, we're just going to take a minute to let everybody here on the panel. We'll go from right to left here, just to give a quick introduction to their company and themselves if they want to add anything, and we'll go from there.
My name is Alex Abel. I'm one of the managing partners of RCP Advisors. I think I represent the allocators or the LP side of the capital flow that we're talking about today. We are a fund of funds platform focused on exclusively North America small market buyouts. So lower middle market is another term that often gets used. One way to think about that is companies that are generally under 200 million of enterprise value. We do primary fund investing, we do co-investing, and we also do secondary investing as part of that mandate. And we've been doing it here in Chicago for 25 years. So it's our 25-year anniversary. Thank you.
Tracy Britt-Poole. Can you hear me okay? Takes a second, I think, to adjust.
There you go.
All right. Tracy Britt-Poole, co-founder of Cambric. We're a long-term holding company investing in consumer, industrial, and services businesses. We started 6 years ago, really focused on being the alternative to traditional PE. So for families and founders who want something different, longer term, more operationally focused, is sort of our avenue and our approach.
Good afternoon. I'm Hank Hartong. I'm the CEO of Brynwood Partners. Thank you very much for having me in to speak today. Delighted to be on your panel. Brynwood's been around since 1984. We are a private equity firm that specializes in investing in the consumer product space, specifically right now a concentrated portfolio in food and beverage. Our strategy is to combine operating skills and investing skills together to accelerate performance, and that's been our strategy since the firm was founded 42 years ago. We've been in business for 42 consecutive years, and the business was founded by my dad, and our returns in the last 20 years have been terrific. So excited to share our story with you today. We have 3 of our 4 portfolio companies are based here in Chicago. Businesses I'm sure we'll talk about during the panel. Look forward to sharing that with you.
Great. Well, first of all, good evening. I'm sure, like you said, it takes a little while for it to pick up. Chandran Thomas, I serve as the founder and the managing partner of the Copia Group, but have spent my career over 3 decades in the capital markets and private investing and investing business. At the Copia Group, our focus is providing customized capital solutions to lower middle market companies. Now, when we use that term, we define the lower middle market as companies, for us, anywhere from a minimum of $5 million in revenue to $150 million in revenue. We'll start looking at investment potential at $1 million in EBITDA up to $30 million, but think about the sweet spot of where we deploy capital, sort of 2 to 15 million EBITDA companies. If you think about the unique parts of our value proposition, we like to say at Copia, we're expanding the aperture of how you deploy capital in the private investment world. So one, we focus on non-dilutive strategies, i.e. we are primarily what is referred to as private credit. And when we're thinking about our investments, I would say today, more typically when you look at private credit, a lot of the capital that you see is deployed into what is referred to as equity-sponsored companies or private equity-owned companies. Ours is a little bit of the reverse. We primarily focus first and foremost in directly investing in entrepreneur-owned companies family-owned businesses, and we do a lot of work with non-sponsored or independent sponsors. We will work with private equity sponsors, but we do that more on a curated basis. So there's the whole value proposition is wrapped around what we call value creation and also economic inclusion, but we'll talk about those terms, I'm sure, during the course of this discussion.
All right, well, let's get into it. So, to start, every business has chapters, whether they're $5 million business or they're a $1 billion business. They have different capital needs and providers, and things are fundamentally different in setting up the company. Chandran, from your perspective, what does a company need at each one of those stages beyond the dollars themselves?
So, of course, everybody focuses on capital access, right? And that's in the sense that when we talk about capital, we're thinking about not just financial capital, but we talk about social capital. But that being said, there's a construct that we have at the Copia Group. We call it our 4 C's. And the way that we think about it, it's the 4 things that are essential to scaling a business. The first C for us is capital, but think capital structure. And so you have to think very intentionally about any business, regardless of the size or scope, about the financing of that business over time, what's optimal for the capital structure. And so a lot of what we do with our team is thinking about what's the optimal capital structure to best allow that business to flourish. The second C that we talk about is counsel. What we find is a lot of times really great middle market companies are not only undercapitalized, they're underadvised. So being able to bring the expert advice or counsel that they need to really grow and scale the business. The third C we talk about is colleagues. And so many of you, maybe you've worked with small businesses, invested in small businesses. Oftentimes, they may be 1 or 2 individuals, key roles from really being able to scale that business, whether it's on the human resource side or the financial management side. So really working closely with companies to help them identify those individuals who will unlock the full potential of the company and bring those on board. And then that final C is clients, if you're in a service business, or you can say customers if you're in a product business. But we leverage not only our own relationships, but our advisory board to say, how can we bring relationships to the business that is going to grow the business? And so again, I think that you have to be much more than thinking about financial engineering. You have to think about really how do you truly drive value in the business? And for us, it's the focus on those 4 C's.
That's awesome. And Alex, just to kind of dive into this further, less than 2% of companies that are private go public. So that's not something that happens a lot. As you look at the space and how these companies think about private capital broadly for permanent financing, how do you see the market and the types of companies you fund?
Yeah, in the lower middle market, almost none of our exits in our private equity funds go public. So it's very different from the liquidity demands in large market private equity. So if we're thinking about some of the big players like a KKR or Bain Capital, it's one of the reasons why we've seen distributions that has been a big story in the private equity world and liquidity be really much different in the small market than the upper market. We've actually had, over the last 6 months, probably record distributions, whereas the bigger part of the market has remained pretty illiquid. Most of the companies that we back through our managers, they're exiting to larger private equity funds or a strategic company that either is a portfolio company of a larger private equity fund or sometimes an independent company. And the reason for that is that the sort of size range that was been discussed about lower middle market is exactly what most of our managers do. These are $5 to $15 million EBITDA companies. They're not that attractive at that size to a bigger company or even a bigger private equity firm. And so the folks that are in the smaller part of the market, they buy these companies at relatively, good valuations. They're small. They have issues that they need to be fixed. So there's an operational component that's really key. And then they can grow them, professionalize them, and scale them, and then sell them into a much frothier market above that has a lot of capital, right? So the vast majority of capital that's been raised in the private equity markets has been in funds over $1 billion to $5 billion, right? That's where the vast majority of it is. So it's a good dynamic if you're buying in the smaller end of the pond and you're the little fish being eaten by the bigger fish. And that's one of the reasons why, the distribution time, or what we call sometimes DPI, distributions to paid in capital, is often much faster in the smaller market funds than it is in the bigger market funds. And all investors like to get their money back quickly. So.
Well, That's a good lead into our next topic, patient capital, because the environment's been changing. And Hank, you're on Fund 9, so you've seen a few changes. And the exit environment has certainly fundamentally changed. We're seeing fewer IPOs, we're seeing much longer hold periods, secondaries, continuation vehicles. There's a lot of dynamics there. It affects both the sponsors and the LPs. What are you seeing as the new reality and how you manage return and liquidity expectations?
Yeah, I mean, that's been something that certainly has changed since I've been in the business. One of the benefits of having a concentrated limited partner base like we have is the capital that we're attracting understands the investment strategy, the team, the deals that we're making commitments to. And as long as we're creating value, then we've tended to have a more patient disposition within our LP base. And I think being a smaller fund, our first fund back in '84 was $14 million against the same strategy we have today, which is to invest in businesses that combine operating skills and investing skills, which at the time in '84 was about leveraged finance, and everyone thought that was a terrible idea. Today it's super fashionable, and I think we've gotten to the point where we're pretty good at it. And so the ability for us to create value in our investments over a longer period of time with an LP base that understands our model and has watched us for 42 years, they're tending not to say, okay, when are we getting our money back, provided they see that we're creating value. And for us, our fund is $750 million, which, that's in the middle of the middle market. We're not fee-driven necessarily. We're really, return on invested capital. We make our money on the carried interest. The fees keep the lights on. So our ability to create better cash-on-cash returns is a big incentive for the management company. And when your LPs are aligned to that, it tends to allow for longer patience around hold periods. The other thing that's changed is as your businesses are performing and you're creating value and you're holding on to them for a longer period of time, the markets for dividend recapitalizations have become much more available. And so your ability to return capital without fully divesting the business, especially if you're creating returns while you're holding it, you get better cash on cash, you're distributing money, which helps your IRR, and you're getting liquidity through the reliable source of investors that are allowing you to do recaps without putting in fresh capital that allows you to have these longer hold periods, which leads to great returns.
That's awesome. And Alex, just coming back to you, from the fund-to-fund seat, so you're providing money out to a lot of these funds. Just give the perspective about how investors are thinking about hold periods and secondaries and even the continuation vehicles when rollovers happen.
Yeah, so I think, a lot of bigger institutional groups, I think you're absolutely right. Like most LPs that are investing in private equity understand that there's a value creation component that takes time. What we have seen, though, is that a lot of big institutional groups especially have had come under pressure from their organizations that they are slowing new commitments until they see more liquidity coming back to their portfolios, right? And so I think that what that has also sort of sparked is a sort of a resurgence in interest in secondaries, right, in secondary funds. So a lot of funds that have gone out in the market have been raised very quickly. And so in secondary funds, there's a couple of different types of secondary, but generally you're buying assets that are already in the midlife of their life cycle, right? So the duration of that capital is much shorter. The velocity of capital out is quicker because you're buying established assets as opposed to investing in a blind pool that will draw down capital over time. So you're buying established portfolios in many cases, and then because they may be in year 3 or 4 of a 5-year or 6-year life, the time to that capital comes back is much shorter. Now what you sacrifice is the ability to generate higher cash-on-cash returns on that capital because you don't have the time element to sort of compound the value creation, right? So the cash-on-cash returns in secondaries tends to be less than what you would see in a traditional private equity, but the IRRs tend to be higher. So the time capital of money is more accelerated, and that gives you higher IRRs for that same level of cash on cash. So there's no doubt that for a lot of institutional investors, especially the sort of move towards secondaries and use the term CV just to explain to the audience, these are what we call continuation vehicles, which is a tool that's really been used, a lot in the last 5 or 10 years. We used to call what are now called CVs, we used to call them restructurings, because it usually was an asset or a collection of assets that were not doing that well. Today, they're really recapitalizations, right? They are a way of creating liquidity for a company or a set of companies that a manager has been managing very well. These are great assets. They want to hold on to them longer, but they also recognize that their limited partners want liquidity back, so they create a choice. They say, okay, we're going to create a new vehicle. You can either roll your investment into that new vehicle, we'll bring in some outside investors to buy out people who don't want to go into that new vehicle, and that creates the ability for that manager to create and hold an asset and continue to compound those returns for a longer period of time, but it also gives LPs like us the ability to get liquidity if we want, right? So these tools are neither good or bad. They have been used both ways by GPs. There's some negative and sort of alignment issues that you have to deal with when you think about CVs, but it is a tool that has become very widespread in the market, and even bigger private equity funds, traditional private equity funds, have raised on the side what we call CV funds to invest specifically in these types of opportunities. So it is a lot of capital that's going in that's creating a whole other way of exiting companies through the private equity system.
Well, that's exciting stuff. We have most of these conversations on capital happen inside the boardroom and on term sheets and with the investors, but often the real work happens inside the company and goes beyond the capital structure. Tracy, you had inherited Pampered Chef while you were in Berkshire Hathaway Corporation, a fairly large investor, and it had been in decline for a while. What does it take to turn a company around in that type of environment? And what do the investors underestimate when they're in that type of situation? And you did that all in a very highly scrutinized environment.
Yeah, so I think a few things I'd say is I think that the first generation of private equity was really focused on financial engineering. We're going to buy businesses for 7 times, smash a few together, and hopefully sell them for 12 times a few years later and get a nice return. Not to mention we're going to lever them up and put a lot of debt on the businesses, 4, 6, 5, 6, 7 times on it. I don't think that's always and very seldom is that actually what's great for the businesses or best for the businesses, although it might be attractive for investors. I think that this next generation of private equity, and we think of ourselves as alternative to private equity, is much long-term oriented in terms of real operational improvements in the businesses. And while I was at Berkshire, I sort of had this view that the investing landscape was shifting and more value would be created on the operating side going forward, and that there's very few investors who've actually been operators. And most investors sort of think of operators as second-class citizens. They don't have the empathy, the respect, because they've never left the boardroom. And I wanted to go get that experience myself. Sort of raised my hand to go become CEO of Pampered Chef, which was a Berkshire-owned business based here in Chicago. Business had been in decline for about a decade, so it was a good opportunity to come in and rebuild the business, rebuild the team, the strategy, the culture. But did that not necessarily just to turn around that business, but to really build a scalable, repeatable business system to go help other mid-sized companies and have that operational experience. Over the course of 4 years, we took it from 30 million in earnings to 100 million plus, and really sort of rebuilt the foundation of the company, which now is our business system, the Cambric business system. And really, I think the key components of that is like, how do you focus on people? I think usually private equity starts with capital or something else versus we start with people. Do you have the right people? Do you have the right culture? Do you have the right support? I think when you have a traditional fund structure, your hold period is so short that you oftentimes don't invest in those things because the payback isn't there. So you focus on cost out or price up instead of like, how do you actually build the company for the long term? And so we focus on people, we focus on strategy, KPIs, budgeting, all the sort of foundational pieces of how you create what we think is sort of more long-term value in a business. And at Cambric, we do that because that's what we operated and we did when we were at Berkshire, and think that's just a better way to run businesses versus sort of the first wave of private equity in terms of financial engineering.
Yeah, that's awesome. And then, Hank, you you do a lot of work in the consumer brands space. You know, how do you come in and kind of look at the same thing, whether they're undermanaged or doing well? How do you help them on the operating side?
Yeah, I mean, well, the first thing we look for, if we can't add value through our operating involvement in the business, we're not going to do the deal. I mean, anybody can put up capital and have an investment thesis around a business that's going to perform because the market's going to take it someplace it can't take itself. We look for businesses that are fundamentally impaired with some deficiency that we feel we can address quickly once we have control of the business, whether it's a lack of management. In many cases, we buy businesses with no people, just factories, whether it's marketing, sales, innovation, failure to have a long-term capital expenditure strategy. We're an asset-heavy investor, so we like manufacturing factories. We have 4 factories here in the Chicagoland area. We employ almost 600 people in this area. So we like businesses where we have the ability to influence the outcome by something that we can control within the 4 walls of the business and the factory. And we look for ways we can do that. Our biggest acquisition we did we're just about on the anniversary of that deal, and we closed in June of 2025. We bought the Chef Boyardee brand from Conagra and merged it into our company, Hometown Foods, here in 500 West Madison, that has Pillsbury baking mixes, funfetti, cake mixes, frozen pancakes and waffles, and a bunch of other products that Chef Boyardee is now part of. And everyone said, well, why did you buy Chef Boyardee? I used to eat that when I was a kid. And I said, well, you know, most of the people that I talk to, you know, this business used to be important to them. And I said, well, we sell to the masses, not to the classes. And you know, Chef Boyardee costs $1.34 on the shelf at Walmart. What have you paid $1.34 for in the last 12 months? Probably nothing. And so, yet it feeds America. We make 1.5 million cans of Chef Boyardee a day in central Pennsylvania, where 500 people work at that factory that, you know, want a job and need a job, and they're looking for the business to grow. And we've been investing in that business to drive new products, innovation, all the things that weren't a priority for the previous owner, not because they weren't focused on the business, but because their strategy was something different. This was a manage for cash. We're going to manage it for growth and for change. And I think when you get into the business, you'll see, just go down to the Jewel on State in Ohio. We have a new Chef Boyardee skillet meal that competes right with the Hamburger Helper, and we're going to take those guys on front and center and give them a run for their money with products that now combine both ground beef and chicken. And that's the kind of thinking that some junior marketing person that was assigned to a non-core brand in the business isn't going to get, and what private equity that's operationally focused can bring to the business. And if we do a good job, the returns will follow. And when the returns follow, we have more patience with our investors. We just did our largest distribution in the 42-year history of the business. We didn't sell the company. We just refinanced it. It's a company that makes, it's a contract manufacturer. We make Monster, Red Bull, Olipop, Liquid Death, Celsius, Spindrift, in 3 different factories. And we've taken 7 times our money out in 8 years. And our investors say, don't sell it. Just keep refinancing it and running it for growth. So we look for, that was a business that nobody cared about. It was an old brewery back in the craft brewery days where everybody built their own factories, and when the craft brewery business got oversaturated, they all turned to energy drinks and became contract manufacturers. And we bought a business. Obviously, we bought it well because we've had 7 times our money out already, and we look for ways that we can extract value from businesses by running them better and doing something that someone else decided wasn't worth the size of the prize.
Ah, that's awesome. Clearly getting beyond financial engineering into operational outcomes. Shundran, when you look at value creation and you kind of look at technology with AI and metrics and just changing the culture of companies, what does world-class look like for you right now?
Yeah, so first of all, like just the frame in our world, I mean, when we talk about, you know, they use these terms, private credit, like it's nothing new under the sun. Like what we're doing is what you would have known decades ago as middle market banking. So when we're doing direct lending, so first I want to situate it there, because the real thing that's happened is the marginal lender has changed. So the marginal lender is not a bank lender. The marginal lender would be a quote-unquote non-bank lender, a firm like ours, but the actual value and the service that we're providing is the same. So that speaks to the value proposition. Because I would argue we're sort of, back to the future. We look like today what I would argue a great relationship banker looked like 3 decades ago. We only focus on industries that we have experience in from a research standpoint or a deal standpoint. So for us, you'll hear some people in the lending business say that they're agnostic to the end market. We have specific preferred industries. Those look like business services, consumer and food, financial services, industrial services, and healthcare. Why? Because that's where we have our experience, right? It's not that we don't like technology and software, that's just not where the depth of our experience is. And we believe when you go in, if you're going to add value, you have to understand and know that business. The second thing you think about when you're talking about adding value are what are the levers? So before we even get to AI, they're pretty straightforward. It's people, it's processes, it's product. Your product can be a service in the service industry, and then it's pricing. Those are your levers. And so done well, the plan that you're putting in place is helping companies drive those levers. And then the last part of your question, so then when we think about technology or AI, it should never, in my mind, be thought of in the abstract. But that being said, AI has a lot to say about how you can do a better job expanding the capacity of the people or making us all our bionic selves. AI has a lot to say about how you can enhance all of your processes in the context of a business to make it more efficient. AI has a lot to say about how you position your product. AI has a lot to say about pricing from both levels, both in terms of how you're operationally more efficient, which means that you can be more efficient with your pricing, and how you position your pricing towards the value you want to represent in the market. And so that's kind of together how we think about value creation.
It's going to be fun to work with you. Tracy, at Cambric, you seem to have systematized a little bit of the thinking about what you bring to your companies with your approach. Can you talk about, kind of how you take their strategy and operating model and help them get through that to get to the next level?
Yeah, when we looked out at some of the greatest operators out there, they tend to be operated with consistent results, a business system. So if you look at Danaher, Toyota, ITW, Marmon, TransDigm, I think they're great compounders. They'll have some of the great returns over multi-decade periods. And if you look at them, they bring a business system, which is a structured way to operate. Now, most of them are working at larger sizes in terms of companies. And so we really built our business system for mid-sized companies who don't have as much in terms of resources, team, software, and sort of support. And so it's really helping them understand where they are and where they want to be. So if you're thinking about people, how do you improve your hiring practices? How do you get better outcomes there? How do you think about talent development, talent management? How do you invest in the culture and the team? You think about strategy, bigger companies have McKinsey or Bain, they can go and hire. If you're a mid-sized company, you can't do that. So how do you build your strategy without them? What does it look like and how do you actually tangibly go through that process? How do you think about KPIs? Who should have KPIs? What are the biggest KPIs in your business? How do you cascade them through? And having been a CEO, really felt like that was not clear, and mid-sized companies have had to effectively do that. So building a scalable, repeatable system. And then tangibly how it comes to life, we partnered with a company, JM Test. It's an industrial service business, so they calibrate industrial equipment. 40-year-old family business. They've done an amazing job growing it, compounding at 20% a year over 20 plus years. But they had gotten to the point where they were maxing out in terms of their sort of bandwidth to manage the company, and were managing it the same way. And we came in, it was roughly $8 million in earnings, and helped sort of build all that infrastructure, the team, the support, the systems, and help empower them. And in most of our cases, we're coming in alongside them as sort of player coaches. So a lot of times, in traditional PE, it's a consulting team or an operating advisor or full-time executives who, previously were full-time and now part-time. And instead, we're sort of coming alongside them to build the muscle in the business so that we can strengthen it. And in that business, we took it from $8 million in earnings to roughly $30 million over 3 years, almost all organic, so very little acquisition. But it really is helping them operationally improve the business and building the muscle within the team and within the company so that they'll be even stronger as they continue to build. And even as we start to sort of pull back our resources, they actually have strengthened over time. And I think that comes directly from our experience of running businesses, struggling and failing and making mistakes and learning. And I always say to our CEOs, like, I don't want your job, I've had it, I don't want to do it again, but I want to help you. I want to be the resource that, I wish I had when I was the CEO. But that definitely is the way that we're thinking about it, of how do we come along and how do we help them. We'll never know the business as well as they do. They're going to be the industry experts, but we can bring in the structured way of thinking of how they operationalize and improve their business and continue to do that.
I think you just said you 3X'd them in 3 years, right? That's what you said? Okay. So I sell a lot of businesses, and it's the first time the business sells, and it's been 1 or 2 generations in a family. It's 40 years old, and it's 10 or 15 million. And then 3 years later, it's 40 or 50 million. That's what private equity does, and it's not just money. When you talk to owners, they'll say, oh, here's all my ideas for growth, I just don't have the money. But money's just something you buy. That's what these people have. They have the money to buy, but they also bring the thinking around all the things that you're not getting out of your own way on if you're a business owner. It's a story we just see over and over. But we've talked about private credit a lot. So we're gonna hop into that one, which is a fun topic. In the lower middle market, and really in most of private equity, debt's not optional. It's always been part of the equation. In the 80s, things were 90% leveraged, and when they blew up horribly. Today, the average deal is 55 to 60% leverage, so it's got some debt in it. Traditional banks have pulled back. We've had some private credit funds come in. SBICs are really sort of a government, kind of a structured way of doing funding that can have both equity and debt in it. BDCs, there's a lot of words around that. But as some of the private some of the banks have stepped back, private credit's really come in, and it's gone from 500 million to 3 trillion in capital today. Alex, you see a lot of this. What do you see driving these structural shifts? And where does private credit best work coupled with the equity?
Yeah, so private credit started really growing about 10, 15 years ago. It's always been around in various forms. And there's a couple of reasons why that occurred, right? So one was coming out of the global financial crisis, where banks basically went completely risk off, right? And what that created an opportunity for was other pools of capital that could provide debt financing in a different type of structure and use. And so today, for example, it's also a very bifurcated market, right? So if you think about the lower middle market with a lot of the companies we're talking about today, probably about 80 to 90% of the debt that's financed in that market is from what we would call private credit, as opposed to what we would say traditional money banks, right? Where you go to a bank and get a loan, even as a private equity firm. And that's very different in the upper part of the market, right? Where you have syndicated loans. It's a very different type of debt market when you're dealing with these very massive transactions. And so one of the things we saw, for example, was that the private debt funds through COVID, right, had another sort of dislocation event, right, where they continued to lend, again, higher spreads, right, as interest rates went up, but the banks kind of, again, shut down their operations. They went risk off on a lot of these companies. And so the private credit markets have done a much better job of keeping, let's say, the lubrication of M&A, right, in the smaller part of the market. And that has drawn two things. One is the use of it more from the private equity sponsors, and then also a ton of capital that's flown in to basically sort of take up that demand, right? And part of the attractiveness for folks that invest in private credit, again, we don't do private credit generally, is that you get a generally pretty good yield, right, on your investment. You get usually a current component of that yield. And you're taking a different part of the capital structure that obviously is seen as less risky than the equity, right? And you're not getting equity returns, but in most private credit funds, they can actually generate pretty good returns, and then they use leverage themselves oftentimes to generate even better returns on that same credit, which of course creates a different type of risk. And so what we tend to see is one of the biggest differences is the use of leverage in these parts of the market. I think Tracy might have mentioned it, but in our part of the market, we see about 2 to 4 turns of EBITDA, cash flow, as being the normal level of debt, usually 40% to 50% of the capital structure, so on the low end of the range that he described. In the upper part of the market, the medians is around 6 turns And in a lot of transactions are actually higher than that, 7, 8, 9 turns that we see pretty often. And part of the reason why the lower part of the market doesn't use as much leverage and doesn't need it is the growth that Tracy was talking about, right? The ability for these managers to grow smaller companies. Most of the returns from private equity managers, the good private equity managers, does come from a combination of growing these companies and then getting a higher valuation for every dollar of cash flow when they sell into this much more efficient market that can bid higher prices because they use more leverage and because their cost of capital and their target returns are very different, right? All of that creates a very nice soup that allows these sort of like smaller managers to buy companies at reasonable valuations and not only get returns from the growth and the leverage, but also from what we call multiple expansion, right? So they may buy something at 6 or 8 times and be able to sell it for 10 or 12 times, right? And so the leverage in our part of the market is still a critical component, but it is much less a part of the return calculation for most of the managers, at least the ones that we're backing in the smaller part of the market.
Cool, cool. And Chandran, you know, you're focused on economic inclusion and non-dilutive investments. Non-dilutive's good. Just talk about how that works in the marketplace for you and maybe how that's competing with the traditional equity financing from the past.
Sure. Well, one, because I think situating this is really important, just to build on something that Alex was saying, because I want to put a fine point on this. If you think about what's happened, if this was circa 2013, about over 70% of all debt financing that we saw go to quote unquote middle market companies would have come from banks. Today, that's less than 10%. Importantly, when you talk about that number of quote unquote the growth in private credit, it's a bit of a misnomer because it's just different who's doing the lending. If we looked at commercial credit, just the credit that is extended to private companies, it actually hasn't changed dramatically over the last 15 years.
It's where the capital comes
This is a really important point. It's an important point because too, when you build on what Alex was saying, if you use last year as an example, 43% of all the new fund flows that went into quote unquote private credit went to 5 firms. 37% of it went to 5 funds. So this ties to the point on economic inclusion. Everybody in this room should care about that, regardless if it's in your investment portfolio or not. Because what we have is theoretically the greatest and deepest capital markets here in the US, but increasingly inequitable. And I mean on every level, right? Today, there are companies that are great, what we would call lower middle market companies, generating $10, $15 million in EBITDA. And the marginal lender that is responsible for allocating capital won't roll out of bed to look at that deal. And so that means something for everybody sitting in the room, because it means over time, the arc of time, reduce innovation, reduce job growth, because great companies in what we call the lower middle market, the engine of this company, the engine of job growth, the engine of innovation, actually today have much less access to the very capital that drives growth. And so from our lens, this is actually really important. So we look at it from the standpoint of, that's why we say we turn it on its head. Most people think about private credit as people lining up trying to lend money to private equity sponsored funds. That's not what we do. I mean, that's not the focus of what we do. We're very specific or curated when we work with a private equity fund, if we're going to work with one, and it has to be mission oriented. The last thing I would say, the 2 things that we look at, not just going directly to business and independent sponsors and family-owned businesses, but also who gets the capital. And so when we're expanding that aperture, what we find in the lower middle market, not surprisingly, there's a higher concentration of women-owned businesses. By the way, women own 41% of businesses in the US, and a much higher concentration in the lower middle market. Higher concentration of diverse-owned businesses, all of which, by the way, are growing faster. And so all of those things tied to this, what is your strategy? Who has access to capital? Who allocates it? And then what are the attractive returns that you can get? Because that's the last part that, I mean, Alex didn't talk about that, but that matters. And it matters in terms of thinking about like the win-win, because you can get actually excess returns in a part of the market where it's 4 times less likely to default. And if you do have a default, you're going to get much more recovery on that default. And so those are interesting aspects that we think about when we think about economic inclusion.
Yeah, that's cool. That's cool. We see a lot of smaller companies now taking debt for their first sort of financing round rather than selling out, and then they own more later. I mean, it's a really big deal if you play that right, and some of the new structures have just enabled a little more ownership a little bit longer, which is really, really important. So that's super cool. You know, Tracy, you've been on both sides of the table. You know, if you put your CEO hat on, and then you also deal with a lot of CEOs, you know, what are they really, you know, looking for, you know, from their investors? And then what type of behavior from investors might degrade, you know, trust and performance? And, you know, how do you think about that in dealing with your CEOs?
Yeah, I think, you know, speaking broadly of CEOs and owners, I think that they're looking for the best home for their business. And I think historically their options have been quite limited. There weren't a lot of sort of opportunities. You know, it was definitely a buyer's market. I think they have seen their friends sell to private equity or someone else, or a strategic, and they've seen oftentimes the consequences of that. You know, my business bought and sold multiple times. My friends laid off that, you know, I hired and I care about. My brand eroded, or my family's name sort of scrutinized or not benefited. And I think that they're looking for, you know, alternatives, and also someone who's going to come in and really do what they say they're going to do. You know, I think there's a lot that is said during the selling process that isn't always genuine and honest and true of what's going to actually happen, because someone wants to buy a business. You know, they'll oftentimes say anything to get the deal done. And I think that there's a growing group of CEOs who really care about who they partner with. They care about where their company ends up, and they want someone who's going to be a true partner to them, not just in capital, but in guidance and help. Is going to be able to compound the business, like Hank was talking about, in terms of the impact in these companies and how do you build them the right way. So I think that starts with people and helping support the people growth in the company. I think that really is focused on helping people figure out the direction of their business. Where should they be growing in terms of markets or geographies or categories? You know, it just gets a lot more complex as you're growing a business as a CEO. And I think trying to find those people who can come alongside you and actually really genuinely help you scale to that next level is what the CEOs that we talk to, you know, are interested in. We have 3,700 CEOs in our community where we provide free programming, events, content on how to run your business better. And almost all of them say, I get at least one call a day from private equity, and they're just getting, you know, bombarded by it. But they still are looking for something different in terms of their partners, for those that are thinking about, you know, taking on a partner.
Yeah, Hank, same for you. You know, when you take a look at the CEO's perspective, what are they looking at from you?
You know, our investment model is probably, I mean, every fund has a different strategy and a different approach. You know, if you look at our team organizationally, the vast majority of the people working on the portfolio companies started in one of our portfolio companies. So we like investors who also have operating experience. We don't have operating partners or using consultants or things like that in these mid-sized companies. We feel we need to be able to do the work ourselves. And so we'll never ask one of our CEOs to do something we haven't done before or we're not willing to do ourselves. And the other thing I think that differentiates us is my dad told me when I got into this business 25 years ago, he said two things. He says, one, don't run the business or try to run this firm from behind your desk. You need to be out with the people, you need to be in the factories, you need to be in front of your customers, meeting with your vendors, and helping accelerate the performance of this business through your operating involvement. That's our strategy. Don't ever forget that. And the second thing is, when I say something to you and you're looking at me and you're rolling your eyes, just remember, I'm not smarter than you, I'm more experienced. And I've seen things that you haven't seen. And over time, you'll understand that that's really good advice. And I say that, and probably the people that know me, if like I've heard that story too many times, but at the end of the day, if you're running a private equity firm in a concentrated portfolio, control investments, and you're not helping your CEOs through your experience or your judgment or your instincts or your accessibility or your willingness to go on the road or tomorrow I'm going up to Gurnee to our pizza factory for a board meeting. Next week I'm flying down to Bentonville to go meet with Walmart because we got some inflation challenges in our space. That's what's required. Our CEOs need our help, and they need our help navigating through problems where our experience provides them with an advantage that they wouldn't otherwise get from someone just funding them with capital.
It's exciting. A lot of hard work on the road. All right. Well, let's bring it home here. Final question for each of you. We'll go right to left again. But Chicago is one of the great business ecosystems in the world, especially in the middle market and down. The firms on this stage are a proof of that here, that we build things for the long term. What's for each of you, what's one principle you've learned from operating, investing in this market that separates the firms that last and endure from those that are just seeking an exit?
Yeah, look, when we are evaluating a private equity firm to invest in, for us, we're looking for something about what they do or who they are that obviously makes them different, but more importantly, we can draw a thread through and see that they can generate repeatable returns, right? And so sometimes I like to call that their superpower, right? So every firm that is good has a superpower, and the superpower could be the ability to create a lot of value, right? Work with portfolio companies, have expertise in their team to be able to do that in a unique way that generates better outcomes. A superpower could be unique ways of sourcing deals, right? And like a lot of managers in the lower middle market, one of their superpowers can be sometimes connecting with these entrepreneur owners, right? Who have held this business for themselves, for maybe their families for 30, 40 years, and they care who they sell it to, right? They care that it's going to be taken care of, in part because they have to live a lot of times with the people that they're operating with, and they can't just walk away and go to an island somewhere, right? So they care about what happens to these companies. They are their babies. And so for us, like every manager that we invest in, we need to be able to identify and find what has caused the sort of success they've had in the past, right? That we can sort of point to and say, this isn't luck, this isn't a market effect, this is something about either their team, their expertise, their process, right? So how do they go about sourcing, adding value, and exiting these companies? And what is it about their strategy, right? So we have groups that are sector specialists that do things like only consumer. We have generalists that have other types of expertise with companies. And then finally, you look in the track record for the proof points that they've been able to execute on those types of things and have success over and over again, right? And that's the key, at least for us.
Yeah, I think what I would, sort of how I'd characterize it as we think about growing and scaling firms is when we look at businesses, we try to understand what's the competitive advantage, what makes this business unique and differentiated, and how is it going to keep competitors in, and how is it going to build the moat of the business over time. Every business has a moat. Sometimes it's narrow, sometimes it's wide, and it's either getting wider every day or getting more narrow. And I think we think of it the same way about ourselves. What is the moat at Cambric? What's the competitive advantage? How do we invest in that? The world doesn't need another middle market private equity firm. There's tens of thousands, and it's becoming more and more difficult to stand out. So how do you continually effectively do that? And then I think the second thing we think about in our businesses is how do you scale and grow them? And how do you think about, do you have the right team? Do you have the right systems? Do you have the right structure, the right management? We manage ourselves the same way we manage our companies, through our business system, with key KPIs and goals that we're managing as we think about team and talent, all of those different dynamics. But I think those are the two areas that I think about in terms of the investment space of, how do you build something that's unique and differentiated? Our goal is to build a generational firm that is building sort of the best businesses in the world. And I think how do we continue to make sure we're doing that every day, and how we look at ourselves, which is similar to how we think about our companies.
So Brentwood Partners has been around since 1984, as I mentioned. We've been around 42 consecutive years. And our last fund, Fund 9, we intentionally raised less than $1 billion, $750 million. I think that makes us the only fund in the United States that can say that. I'm pretty sure about that.
Probably.
You would know better than me.
Probably.
Yeah.
Very disciplined.
Thank you. And, and if you look at Fund 6, 7, and 8, which are the funds that have, there's only one company that hasn't been realized in those three funds, so they're mostly realized, are over 20 years, those three funds each have a gross IRR of over 40%. So we did it for 20 years. So the question was, what makes a firm survive, and how does, the answer is, at least for us, is our strategy and discipline around our strategy and what makes us a great investor. I was calling on this afternoon on a prospective new LP And we talked about our strategy slide. It was about controlled investments, using conservative leverage, operational controls. And I said that slide, when I first started presenting it, we had on an acetate that we put on an overhead projector. It hasn't changed. It's been modernized for graphics and so forth, but it hasn't changed. And I think, people said, well, with gross IRRs, 3 consecutive funds over 40%, a few people, why didn't you raise more money? I said, well, we could have probably, but it would have made us a different firm. And we can focus on the things that keep us going and make our investment results the way they are by not getting bigger, but just continue to do what we're really, really good at. And I think to your point about so many funds out there, LPs are looking for a product that's reliable, is disciplined, consistent, and can perform. And when you start chasing big fees and other things or changing your strategy, you tend to get lost. And so that's why I think we've been able to do what we've been able to do.
Yeah, so I just have to say this, listening to Hank, if we told you we had 40% gross IRR, they have a term for that in our business. When you're a lender, it's called usury. So you can't expect that with us. But what I would say was this. I mean, how we come to the world and what we're providing, right? We have asymmetrical payoffs, right? At its heart, we can only earn our capital back, right? And we can do that in a way that provides exceptional, though, risk-adjusted return to investors. So two things that we focus on when you get beyond the strategy and all those things. And they're a reflection of how we see ourselves. That's mission, and that's, to me, the value that all values tie around, which is humility. From a mission standpoint, we start with ourselves. We have a transcendent mission at the Copia Group. We say that, look, we're trying to create a more inclusive form of capitalism. It's just the thing that drives us every day. It's the thing that pushes us on the hard times beyond any of the financial motivators or any other things that go along with the job. And so when we're looking across at the company and we're making that final decision if we want to invest, we're saying, are they mission-oriented? What is the thing that ultimately drives them beyond the financial bottom line? Because when you can get in touch with that and you can believe that that's there, you can have a confidence when the proverbial rubber meets the road that they're going to make that commitment that they've made when they borrow that money to pay it back to those investors. The second thing I look for is humility. Like, I'm blessed in my business. My dad used to tell me everybody has something to teach you if you're willing to learn. I just work with exceptional people. My partner is like a credit savant. Yvette Taylor, who's here, I mean, she's forgotten more than I've learned about certain aspects of it. And so I try, at least for myself, and we all try to have a learning culture, showing up every day, understanding that. And so when we're talking to people, when we're making that final decision, part of what we're looking for is humility. Because once we sign that agreement, right, we can't force them to do anything. There's a commitment that they have to the partnership that we have and playing out whatever the term of that is. But when you can see that they're willing to listen, that you just know that when that humility is there, that they're going to do the things that they need to do to create and continue to grow a great business. So those are the things that we look for.
Okay, well, awesome. What an amazing conversation. Thank you to the panelists. This was superb. Hopefully we'll continue this a little bit in a more relaxed environment. And I'd like to invite up Michelle Kurz from Riveron to give some closing remarks.
Good evening, everyone. I'm Michelle Kors, Chicago Market Leader here at Riveron, and a member of the Board of Advisors with the Executive Club. Thank you to Roger and this wonderful panel for the fantastic conversation today. We really appreciate the dialogue, and I know we have much to share over cocktails. As you heard today, the bar is higher than ever, longer hold periods, sharper expectations, and AI moving quickly into real execution. It all comes down to one thing: delivering results, and that doing it consistently in an increasingly complex environment is essential. That's exactly where Riveron comes in. We sit at the middle of that journey, partnering with private equity firms and management teams to solve the hard parts of value creation, executing transactions, building the finance and operating infrastructure to scale, navigating complexity, and driving performance when it matters most. We're proud to support this conversation today and bring people together, and we hope to continue that conversation over cocktails, and I think there's still some food back there. So thank you again for being here on behalf of the Executive Club, and we look forward to seeing you soon at future events. Thank you again.